What's going on, everybody, and welcome to the video. In this one, we're going to be talking about a stock that I recently found that I think has a great amount of upside potential. We'll look through some financial models that I made and a few different key things about this company that I find to be pretty intriguing, and just a lot of different things about the company's named Box. We'll go over what the company does and everything like that. But if you do enjoy this type of content, all I ask you subscribe to the channel and you turn on post notifications so you do not miss out on any of my future videos. But let's go ahead and get straight into it. So as I said, the stock we're talking about is Box, ticker BOX. Currently trades for about $28.96. Just looking at the technical analysis, we have a pretty big gap right here. Will be interesting to see if this fills and whether or not it fills soon. And almost right now, we are trading kind of at a level of resistance. So we'll see, we've kind of tested this before and we're testing it like at this current moment. So we'll see how this goes. The MACD looking pretty good, kind of building some momentum on the daily. But other than that, let's kind of talk about a little bit more about the stock. Over the past week, it is up 6%, making some pretty good moves. But over the past 6 months, it is still pretty flat. Recently went from about 33 down 13% since March 1st. And then over the past year, up 8%, but year to date, we are down 7.5%, which is another reason why I think it could be a great buying opportunity given all the things that I've found. So if we want to just look at a few important things about this company, first up, just the market cap is about $4 billion, forward P about 15.8, price of sales about 4.07, but really what's important is these earnings per shares. So the earnings per share next year expect to be about $1.79, which is huge growth coming up from their most recent of 4 cents. Earnings per share next year, 24% growth. Next 5 years, 20.38% growth, which is very good, like compound annual growth. But just to show you a little bit about this company and who they are, they're a software company, helping other companies and people in general simplify how they work, helping corporations and businesses, all the employees involved, kind of connecting their work together and being able to all store it in the cloud so they can share their work and work collaboratively as a team. So let's go ahead and talk a little bit more about who this company is and why I'm liking them. So their Q1 revenues and earnings did beat their estimates and they have risen year over year. Total revenue is about 252 million, beat that consensus, increased about 6% year over year, which is a little bit slow, but 10% with the currency adjusted. Non-GAAP margin, gross margin was 78% nearly, up a little bit. And then non-GAAP basis, they had an operating margin of almost 23%, which is a very good number, which expanded about 220 basis points. Also very good. They generated free cash flow of about 108 million, which is a very good metric. And I can keep saying very good, but pretty much what we're seeing is this company is putting in very good numbers, 260 million, 262 million for their next quarter, which would be a 7% rise on their past quarter fiscal year reported figure. And then non-GAAP basis, earnings per share about 34 to 35 cents for the quarter, very good. Margin about 24%, so increasing that as well. And then for the fiscal year, they expect to get about $1.05 billion in total revenue, increasing again about 6%. They expect earnings per share about $1.44 to $1.50. So this is a very good thing, and their non-GAAP margin expected to be about 25.5%. Really good numbers. So I want to show you a little bit first off in their investor presentation. Revenue growth, as we saw, has been growing pretty well. And then go through my key highlights. Non-GAAP margin increasing and increasing. A little bit lower in this most recent quarter. They already in their fiscal year of 2024, which is why it is saying 2024. Their cash and cash equivalents, they are in a very good financial position. In their share repurchase program, they purchased 1.7 million shares for 44 million in this last quarter. So that is a good thing to see in the event of shareholders are slowly getting less and less diluted, owning more in the company as they buy more shares. And they do have a lot of growth forecasts. So annual revenue, it's been growing very good. And their free cash flow margin also as well, been growing very well. So we're seeing a lot of good things. So this company is doing very well. But to kind of explain what this company does, like I said, they help companies store stuff in the cloud and help them all work in a very easy manner, which is a very important thing, especially in today's world with a lot of people, working from home and all the different things that have been going on. Seeing their revenue growth, all the different things, very good. They were recently net income positive for this past year, about 6 cents per share for the entire fiscal year of 2023, which ended January 31st of 2023. And then some analyst things, and we'll look at my kind of models and my valuation on the company. 15%, almost 16% upside for the company, giving it a price target of $33.43 with 7 buys, 1 hold, and 1 sell. And looking on Wall Street Zen, we can see 3 analysts have 3 strong buys, 3 buys, and 1 sell. Average forecast, again, about 17% upside. max about 37, and a minimum about 26% downside on 21%, which is going to be from that sell rating. Just kind of looking at how recent these are. The most recent was the sell, but then on that same day, we got a 32 price target and a 35, both with pretty well upside potential. But let's go ahead and kind of look about what I built and what I made for this company. So this is the DCF model. Just looking at a few different key things on this company. If we look at how I got the WACC of 8.94%, we'll just go right here. I use the CAPM model. It's always what I use. But, taking their cost of debt, assuming it's about 5%, a pretty good average cost of debt for a company like this, and then their beta is about 1.01, we get a WACC of 8.94%. So using the DCF model, taking their numbers from their financial statements, these 2 years are the growth rates and revenues that Yahoo Finance is expecting, and then seeing everything like else. These are kind of some expectation numbers that I expected looking at the market and the CAGR that we're seeing, and the kind of growth in this economy for this market as well is very good. Taking all these numbers, going to the unlevered free cash flow to the PV of the free cash flows, taking the shares outstanding by their equity value, we get a share price of about $40.87 from its current price of about $28.82. This gives it about upside of 41.81%. And then just looking at their income statement to kind of show you a little bit more, I'll zoom in because it's a little bit hard to read. But right here, this is actually 2021, 22, 23, and then projected out till 2028. So we'll see these are the revenues and kind of their entire income statement. But to show you a little bit more, here are the key metrics about this that is pretty important. The orange is my estimate on how it'll be. The blue comes from the DCF model, so those are the estimates from the DCF model. And any purple is actually the math that we've seen. So earnings per share growth is expected to be pretty well. Income taxes, percent of revenue, all the different things. And we're seeing net income right here. This is the key thing I want to highlight. Going to, if everything goes out as play and these forecasts are correct, net income is going to be growing very well. Earnings per share also going to be growing in a good number. And this also should probably be a little bit higher, just in the sense of they're buying out more shares, and the net income is expected to be honestly a lot more, because we've seen that $135 or $150 range, and that would give them really high net profit margin. It's about 3.4% right now, but if we kind of adjust this to about, let's say 11%, we get about 80 cents a share, and that's on the very, very conservative end, which is still very high growth for this company. And then looking at kind of a comps valuation, I took 4 of the key competitors from tip ranks, which would be HubSpot, Okta, Palo Alto Networks, and Dropbox, taking their average on the PE, the price to sales, not the price to book, because we could not find that for Box, the price to cash per share, and the price to free cash flow per share. Taking these, here are the calculations on how I got the price from a current price about $28.97. The average valuation on this company, when you compare it to their competitors and how they're valued in the market, we get a valuation about $45.07, giving the stock upside of almost 56%. So these are some very solid numbers. I just kind of wanted to point out these key things that I'm finding on the company and why it could be a great buy right now. But remember, this does not guarantee returns or anything. It's just showing the kind of value that the market might be perceiving for this company right now. So that's going to wrap it up for this video. If you did enjoy it, make sure to subscribe to the channel and turn on post notifications so you do not miss out on any of my future content. Thank you for making it to the end of this video. Leave a comment below with your thoughts on this stock or any stocks you want me to cover, and I'll do my best to do that. Check out the links in the description down below for some very good resources, and I will see you in the next video.